just because a lot of investors are buying real estate, but they have no capital. And then they're going out to raise a lot of money. But for me, it's the other way around is that I need to have my own capital before I even raise more capital for these bigger buildings. Because worst situation is if the economy were to shift or I was responsible to get that capital and pay back those lenders, at least I have a fallback, right? I can liquidate one property, worst case scenario. I can liquidate another one if I need to raise more capital to pay people off. The other thing is I can always liquidate to buy bigger real estate, right? So a lot of the sophisticated and well-known investors that we have, like they do have a lot of small multifamily property that they're willing to liquidate now to buy bigger assets. But for me, I don't want to be buying a 20, 30 unit building and having like 10 equity partners and getting a small portion of it. Because for me, I'd rather own 100 units myself than 1,000 units with, 10 other people.
When scaling your real estate portfolio, you sometimes have to ask yourself, would I like a few pies all to myself, or would I prefer many slices of different pies? This week, we sat down with Myron, and he shared his experiences scaling his portfolio with no JVs, tips to ace your next residential commercial appraisal, and much more. You're listening to the Black Wealth Effect podcast, where we're all about inspiring the next generation of Black Canadian real estate investors to succeed financially. If you're tuned in, that means you're hungry to take action and build wealth outside of your 9 to 5. We'll be sitting down with Black real estate investors, entrepreneurs, and allies to discuss a diverse set of topics to help you along your investing journey. Let's get started. You're listening to another episode of the Black Wealth Effect podcast. I'm your host, Mario. Please like, subscribe, and comment on the episode so we keep bringing you this great content. We have a very special guest this week. Myron, welcome to the show.
Hey, man, thank you so much for having me. It's been a while, but definitely looking forward to today's chat.
Yeah, it's been a long time coming, and we're definitely excited to have you on as the show.
Likewise.
So there's a bunch of things I want to cover today, and we really want to understand and learn about your investing journey. And so to start, if you could just share a little bit about your backstory, maybe like what motivated you to like delve into real estate investing, and maybe talk about your first couple of deals as well.
Yeah, of course. So I graduated university in 2017 and 2018. And during that time, everyone looking to get that full-time job. So once I first got that job with that paycheck, I kind of did the math in my head. I'm like, this is going to be very difficult to kind of get to that luxury lifestyle that I've always envisioned. And of course, it was only my first job. So I looked to put that into the number of hours it will take. And long story short, I started, working toward my career. So I'm in commercial real estate. I'm a commercial appraiser by trade, an AIC candidate, which means that I'm not fully designated, but I have the license to kind of practice, write the reports, engage with clients. But I have executives who sign off on the reports. So that's when I kind of got into the real estate investing game because I was like, shoot, I was running all these appraisal reports for institutional clients. And I'm like, I could do the same thing for myself, right? Like if these big guys, billion dollar companies are putting the deal together and making a lot of the money on the forced depreciation and the way they're structuring the deals, I should be able to do this on a smaller scale. So that's when I started getting a lot of things into the pipeline, started thinking a lot, and I landed with my first deal in Windsor, Ontario. Now, I didn't really understand cash flow. I didn't really understand how financing works in the residential side, but I put an offer and I was making like about $800 a month in cash flow. And that's when I just had a bell ringing. And if I do this 5, 6 times, I could easily replicate my income without doing any work. Now, everyone thinks cash flow is like, you can live off after a couple of properties, but in the first property, like it was just a reality check. Like I never knew that. So that's when, this was October 2019, COVID hit a couple of months later. And I started doing some research in terms of how to refinance, how to qualify for more mortgages. The banks were letting me. So that's when I started educating myself in terms of how is it possible that a lot of these guys that, both of us follow have a substantial real estate portfolio. And instead of questioning myself, instead of why could I not, I started focusing on how can I get qualified and build a real estate portfolio. Long story short, I kind of learned a lot of the fundamentals, started applying. And as of right now, in the last 2.5 years, I've purchased 13 properties and around 40 doors, solely owned, no JV partners. That was something that I wanted to pursue, do a lot of creative financing, buy the right property with the right numbers. And until this date, I'm still looking to grow without JV partners.
That's amazing. Like you've definitely had a lot of success in like a relatively short period of time. Kudos to you for that.
No, I appreciate it. It's been a long journey in a short amount of time, but definitely looking forward to taking it to another level.
That's awesome. And so, like, separate from obviously just like finding the deals, kind of building your knowledge, were there, or like, what were some of the like early challenges you faced, and like how did you overcome them?
Yeah, great question. So the first one in the beginning was having a single income. So typical salary out of college, university is around the 50 grand for a basic job. And there's only so much you could qualify for. So the biggest thing was, okay, you got one mortgage. Like, how are you going to get that second mortgage? And the bank give you two options: save money for your second down payment, or you have to wait for the property to appreciate to be able to get more capital. So those things didn't really work with me because I was like, how many times am I going to really increase my salary, and how long is it going to really take me to save? So these are a lot of the questions that I had to myself, but I seeked answers for. And that's where you have to start going outside your network instead of, your current friends, family, your colleague, and find people who've already done it and learn the strategies that they have applied. So the third thing was, once I kind of figured it out, was access to capital. Like, how are you able to get capital? But then I came across a term called vendor take back. I'm like, this is curious. Like, it sounds like a scam, but for the listeners that don't really know what a vendor take back mortgage is when a seller finances a portion of the purchase price. So it can be the down payment, it could be however you want to structure it. So half my portfolio was purchased with a seller funding a portion of the down payment. So it didn't really require me to use all my capital in one purchase. It allowed me to spread it over multiple purchases. And that's the beauty of real estate is you see online, you see these newspapers where they make a generic report. Hey, you need to make $200,000 to buy your first home in the greater Toronto area. Well, that could be correct if you're buying a home. But the problem is that most individuals now are focusing on buying a home rather than building a lifestyle.
I love that. Like, I love that you called out just the importance of being creative and looking into
Hmm.
creative financing options to scale. Right. That's awesome.
Yes,
And so you touched on your background. Obviously, you mentioned that like your focus is commercial appraisals. For the listener that like has never done an appraisal, doesn't really know what it is, can you talk about the differences, like, or actually define what it is first, and then maybe talk about the differences or considerations between residential and commercial?
of course. So residential typically is, we're going to talk about like the residential asset class. So single family, duplexes, triplex, and most of it are fourplexes as well. The reason for that is they're typically residential financing. So residential and commercial financing are a bit different. Residential is based on you as an individual that is kind of qualifying for the mortgage, but there are products available where you can the down payment, offset the debt servicing with the rental income and then commercial based on the performance of the asset. So that comes to commercial appraisal. And the difference between that with residential is that with residential, the value is based strictly on the comparable sales. So if you have a single family home that transacted, that you're looking to get appraised, then an appraiser is going to look at similar properties that are being sold in that area. So for the single family home, duplex, triplex, fourplex, they put there's limited amount of value that's put on income. So to like, depending on the rent you get, it impacts the value much less compared to a commercial asset. Whereas a 5 unit building, 6 unit building, 100 unit apartment building. It's strictly based on the performance, which is the rental income. So a lot of people love commercial real estate, especially multifamily, because they can buy underperforming assets with rental income. And let's say all the rents are, $500 a month and they're all one bedroom, but rent in the area are being rented for, like $1,400 a month that are fully renovated. Well, that's a $900 increase in rent per unit. So that's where a sophisticated investor will kind of do the underwriting and an appraiser will come in to see, okay, hey, this is the potential of the asset and this is what the current value of the asset. So, and you're not being qualified based on your personal income. It's strictly based on the performance of the asset. So there are a lot of, that's a very generic analysis on like the difference between residential and commercial appraisals. But for me, residential is the fundamentals are very economic driven. So a minor shift and things that are being sold can impact your prices right away. Whereas commercial, the data is much lagged because there's only so many commercial transactions available and the period it takes it to close is much longer. So like a cap rate, which is a metric that is used in multifamily real estate or any income producing commercial real estate. But in this case, we're focusing on multifamily. The cap rate is an indicator in terms of what the performance of the asset if the property were to be bought in cash. So if a property sold now, it was usually a 6 month closing period. So as an appraiser, most realtors, they would only have an idea of what that cap rate would be once it's closed. But that purchase price and that transaction is based on the current economic fundamentals of right now. So it's a very data led market, but sophisticated appraisers, reach out to agents, they have a mortgage agent, they have a lot of information and start kind of giving you a very in-depth analysis.
I
But
love it.
that's generally what the difference between the residential and commercial appraisals are.
Okay. And then for the call it like beginner investor that's going like or like preparing for their first appraisal on either side or on both sides, like what advice would you give them? And then like what are some common pitfalls or
Okay.
challenges like an experienced investor might experience in that scenario?
So in regards to residential appraisers, they're looking more at the quality of the renovation. So it's important that you kind of document everything, so that you're submitting like a report for school, right? So you're talking about. So I've done a few residential, like not myself, but like on the properties that I own. Like I've had to refinance or acquire multifamily residential properties, and when I'm dealing with the residential appraiser, I kind of tell them, hey, this is why I bought it at this price. Because what a lot of residential appraisers do is that they use the purchase price as more of a benchmark. And they're like, oh, like you bought this for 300,000, like that's pretty cheap. If the market, that same property is transacting for 400,000. So you always want to tell them why you were able to get it for that price. Was it off market? Was it listed on the market? So I kind of tell them the story behind it because I, for me, speaking as being in the industry, I feel like from a residential standpoint, you want to tell them strictly why it was purchased at that price. And because sometimes, let's say you buy it at 300,000, but the market value at the purchase price was 400, but you only have to put $50,000 and your estimated value is 500,000. You don't want the residential appraiser to be like, hey, well, you bought it at 300,000, you put $50,000. Like, how is it possible to be valued at 500? Right. And a lot of lenders ask that question too. So important you kind of document that story, the renovation that were put in. So get the invoices, pictures, any the renovation that were completed. So it could be capital expenditures, the waterproofing, roof, windows, cosmetic renovation, which is like flooring, kitchen, bathroom, paint. So you want to make sure you document as much as possible and you show the appraiser, hey, this is what you're able to do. Now you want to show that, hey, like these are the rents that you're able to get because these are the quality of renovation that you were able to do. And hence why you were able to get the top end of the market rent. You want to support it. And it's always important to support it rather than you telling an appraiser, hey, I think this is what it should be. Because an appraiser is not going to take what you say into consideration. Like you want to be able to support it. The commercial side of things is a bit different. Yeah, we look at the quality of the renovation, but the quality of the renovation typically relate to the income that's being produced on the asset. So if you're getting the high end of the market rent for a 3-bedroom apartment unit, well, typically your renovation should probably be able to attract those kind of tenants, right? Like if you only have average renovations, it's going to be very difficult for you to get those kind of rents. So it's all income producing. So the income of the asset is going to relate to the value of that property. And typically that's when the cap rate is used. And the cap rate is strictly based on the net operating income of the building. So we look at other properties that are sold, look at the net operating income per unit on those. And the lower the net operating income, also called NOI, typically those properties transact at a lower cap rate. The higher the net operating income of the building, the property typically transacts at a higher cap rate because the property is already stabilized with limited room to add value to the building. So keep in mind, you got to make sure you compare the same building. So like you're looking at a Class C apartment building, which is like a 1960, 1970, 1980, those kind of building, maybe even older than that, then you want to make sure those cap rates are from those same buildings. If you're looking at new construction, well, a new construction is a more superior asset class. So the cap rate will be much lower, even though it's fully stabilized. So you want to get an idea on both. And cap rates also tend to provide you with a factor of risk. So cap rates in Toronto are very low. It's looking at about 2 to 3% because it's a low rate of return due to the quality of location, right? Same thing with buying stocks. Like you're only going to get, depending on the stocks you buy, like if it's a high risk, you get a higher reward. But if it's a low risk, you get low reward, but it's sustainable. So that's the best part with real estate, kind of understanding that. And for those of you, if it still look complicated, think about you buying a retail plaza. Would you buy a retail plaza with a Shopper Drug Mart as as a tenant? Or would you buy a convenience store that is part of a retail plaza? You would for sure choose Shopper Drug Mart or maybe even a bank because they're institutional recognized tenants. So you know that there's no way for them to go bankrupt. So those properties will typically transact at a lower cap rate due to the quality of the tenants that are available.
Yeah, I love that example and great tips. And so, like on the residential side, to your point, what I'm hearing is obviously like being clear around the thought process around the purchase. To your point,
Mhm.
like analyzing comparables, putting together that package to be able to articulate the value you created with the renovations, extremely
Right.
important. And then on the commercial side, you talked about obviously being mindful of the cap rate and the asset class, and then being strict, like just
Mhm.
like thoughtful around that as
Of
well.
course. Yeah.
Right. That's great. And I'm assuming in terms of pitfalls or some of the major pitfalls for first time investors was likely just not doing any of those things that you just shared, right?
Yeah. So when I got into commercial appraisals in 2019 and it took some time for me to kind of understand how it worked. But my second investment property that I purchased was a biplex. So it was already commercial. And before that, I had offered on 2 other biplexes, which I did not go through. But the reason the offer got accepted, but I didn't go through with it because once I got those properties under contract, I was literally like, I had to figure out how to get financing if the deal made sense. So I was under pressure because I had a 5-day, 10-day conditional period, whatever it was, and I had to make sense of it. So that was my test in terms of, okay, like I have something under contract. I have some conditional periods, so I'm safe, but I need to be able to figure this out. So it's only on my third 5-unit building that I offered on that it really made sense. It was all brick, great location. It was the most expensive out of the other two that I bought, but I was willing to pay a bit of a premium to be in a better location, a better lot. So I bought that for 540 and it just got appraised like last month for 960. Sorry, got appraised 2 months ago for 960,000. So I pulled out about, good chunk of capital. So, but those other properties, even though I would have got my capital out based on the purchase price because they were really good deals, I wasn't willing to deal with the quality of the tenant because owning property is one thing, but you still got to be able to get rental income to cover your mortgages. Last thing I wanted was having all these properties, but having to use my own money to pay for the debt servicing.
Exactly. Okay. Yeah. And so, like, the market's obviously shifted quite a bit, like, over the last, call it 3 to 6 months, especially in
Right.
the last 3 months. I'm curious, how are you currently pivoting your either your strategy or your approach given the
Right.
current market. And although we don't have a crystal ball and we don't know what's going to happen, if you were asked to take out your crystal ball and kind of predict like what you anticipate seeing for the rest of this year, like what would that be?
So I have two approaches to this. So right now, obviously rates are much higher. So you got to put much more of a higher down payment to, especially on the commercial multifamily side, because sellers still have not been able to adjust to where the market is and people are still buying. Like at the end of the day, yeah, the market's kind of shifted from an interest rate standpoint, but people need shelter. And with the immigration coming in, everyone's always talking about it. Like people need places to live and development is not up to the projection of the population coming in. So for me, from an investment standpoint, I do want to get into the bigger building, but I'm looking at my portfolio for 5 years from now in terms of, okay, like if I want to get into the next game in terms of development, bigger 20, 30 unit building, like I need to be able to have a good portfolio that I can sell. And the easiest property that I can liquidate are duplexes, triplex, and fourplexes. So I wouldn't do single family home, just it doesn't make sense. But even duplexes are getting very hard. But if you can buy them in the right location, that still makes sense from a cash flow standpoint, and you can still get all your capital back out. I would consider doing it just because a lot of investors are buying real estate, but they have no capital. And then they're going out to raise a lot of money. But for me, it's the other way around is that I need to have my own capital before I even raise more capital for these bigger buildings. Because worst situation is if the economy were to shift or I was responsible to get that capital and pay back the lenders, at least I have a fallback. Right. I have to liquidate one property. Worst case scenario, I can liquidate another one if I need to raise more capital to pay people off. The other thing is I can always liquidate to buy bigger real estate. Right. So a lot of the sophisticated and well-known investors that we have, like they do have a lot of small multifamily property that they're willing to liquidate now to buy bigger assets. But for me, I don't want to be buying a 20, 30 unit building and having like 10 equity partners and getting a small portion of it. Cause for me, I'd rather own 100 units myself than 1,000 units with, 10 other people. It's just more complicated. It's a different game. And
Yep.
everyone always says like, be would you rather own a small piece of a larger pie or have the entire pie? And some people are willing to get a small piece of a larger pie, which is fine. But I think there's a time when that selection is the right method. But I think in the beginning, you want to be able to build all the wealth and where the economy is going, kind of trying to answer that question is look at the rates are right now probably at almost its peak. So underwrite the deal where, okay, if the rates were to go down, and even though the numbers are tight with these rates, would it still make sense to hold long term? And I think right now, for me, in this kind of market, I'm finding opportunity versus duplex or triplex or fourplex, but it's on a good plot of lot size where you could basically break it down and redevelop it at a 10, 15 years down the road. So buy those at discounted where the market is, but you still have a highest and best use if you want to take it to the next level rather than just capping it out as just a duplex. So there's a lot of opportunities out there. I've seen a lot of investors pick up great deals. So always keep your eye on the pulse.
Nice. I love that advice. And I love also that, like, from your perspective, like you're thinking about it not only in terms of like what's happening now, like in the market, but like long term based on your goals. I think
Right.
that's awesome.
Yeah. It's great. Like I think there's a lot of people doing very different things. There's no right or wrong answer. I think it really comes down to what your goals are and like, what is your purpose in life? Right. For me, like it's life by design. I need to focus. I'm trying to design my own lifestyle. And for me, I do want to have that dream home. I do want to have that nice luxury car, but they're the right way of doing things. And you want to make sure that if you were to buy that dream home for your children and the next generation, if you were to buy that car for yourself, or if you want to explore the world, like everyone's different, like everyone's definition of success is different, but there's a way of doing it very comfortably where you're not putting all your eggs in one basket and living paycheck to paycheck.
Diversification is key. That's great.
Yeah, agreed. Agreed.
Yeah. Okay. Yeah, no, and this has been a great conversation. I really appreciate you sharing your experiences and various insights. To round out our conversation, like if you were to, so you, once again, like you obviously have a ton of experience. If you were to like go back in time and speak to your past self, like before beginning to invest in real estate, what advice would you give yourself? And then lastly, like what advice would you give like someone looking to get started in investing in today's
Yeah.
market?
So I'll definitely give the same advice to myself if I were to get started from the beginning, and to others that I would share is really focus on who your surroundings are and the people in the room. So when I got started, and unfortunately there was, COVID hit by the time I started, so everything was locked down. So for me, like joining all these online webinars, like I only knew people by faces. Like I'd never met them in person. So really join or take the time to meet people within the real estate community, because I think that would add a lot of value to your network. If you're looking to invest in a city, go to that city. I'm an old school guy. Like when I first went to Sudbury, and at that time I didn't know who was investing in Sudbury. Either I wasn't following the right people, or I don't think many people were investing there because everyone was focusing on Windsor, Bushy, and like in my network. So when I went there, I had no one to rely on. So I physically went and I talked to different agents, talked to different people. Like I went to a local bar in downtown Toronto, like by myself, got lunch. And I asked the bartender, I'm like, hey, like, what are the different neighborhoods that you would consider moving to? Because the number one thing is that if you ask the real estate agent what's a good neighborhood, they could be very biased. They might be
Yeah.
like, oh, this neighborhood is great. Like I remember my second property that I purchased, like I got it under contract, and it was the fiveplex I was talking to you about. And I've been to Sudbury once, but then when I did my research on the location, there was a drug bust the week before, two houses down. And luckily I caught that, but the agent never told me that. But when I asked him, when I got the property under contract, he said, yeah, it's a good location. So I don't use that agent anymore. But for me, like especially new investors, agents may be a bit biased on what location you want to invest in. So make sure you ask local and people like local individuals or people that are not really affiliated in real estate to kind of give you the true answers. So I say number one, build your network, understand and educate yourself. So $5,000 is not a lot of money to spend on yourself in education. Like a lot of us spend 30 to 40, maybe even $50,000 on a college and university degree. So I've spent about 30,000 on myself right now, 30 to 40,000 probably. And real estate mastermind, some coaching or mentorship. I never did a coaching. I never had a coach yet. I've had a real estate mastermind, but a lot of the stuff that I've been involved with are like webinars where it's like self-learning, self-taught, where you just hear someone talk and then you kind of take notes and kind of learn from their experience.
Awesome. Well, wise words to live by. Thanks for sharing that.
Yeah, that it didn't come from me, right? A lot of the geniuses ahead of us are all talking about it, and they've done the same. And then for me, I'm just trying to pass it down to those who are looking to get started.
Awesome. And thanks again so much for joining us. It's been a tremendous conversation. I know you were a bit under the weather today, so appreciate you still
Yeah,
coming
no,
on.
all good. Thank you.
To our, yeah, go ahead.
No, I appreciate you reaching out. Definitely had a great time, and definitely looking forward to connecting in person.
Awesome. To our listeners, thanks for tuning in to another episode of the Black Wealth Effect podcast. Catch you later. What was the one thing you heard today that inspires you to take action? Now plan to take that action in the next 24 hours. If you're looking for more support, ideas, or just want to connect with others like you taking action, join us in the Black Wealth Effect Facebook group. The link is in the show notes. Thank you for listening, and we'll catch you next time on the Black Wealth Effect podcast.